So money creation, broad money creation happens from either monetized fiscal deficits or bank loan, fractional reserve bank lending. And in most years, new bank loans, net new bank loans, are bigger than the deficit. So more money is being created from fractional reserve banks lending it into existence than it is from the government spending it into the economy and having the central bank monetize it. And the generally speaking, the exceptions for that are during recessions. So bank lending slows down, everybody's more cautious, and then fiscal spending increases either because tax revenue is weaker or because they're purposely trying to stimulate. So you have brief periods where fiscal deficits are higher than bank lending, but not usually. In the current period, throughout an entire business cycle, fiscal deficits exceed bank lending. So we have fairly sluggish to moderate bank lending and higher than normal fiscal deficits. And the Fed's tools, I mean, the Fed can't do anything about oil, right? So if you have an oil shortage, that's just not something they can address for obvious reasons. But likewise, if the fiscal authority came out and said every American gets $10,000 checks right now, right? The Fed that's going to be inflationary, and the Fed can't really do anything about that. And so basically, tools are less effective at fighting inflation when they're not based on bank lending, when they're based on the government spending more money into existence. The only way the Fed can really fight back is try to do quantitative tightening while they do that. But then we see who blinks first, because one of the Fed's kind of shadow mandates is financial stability. So if treasuries start, fluctuating in price like a meme coin, and banks are like facing solvency issues, and treasury auctions are borderline failing, the Fed kind of, at the end of the day, if the Fed and the fiscal authority fight each other, the fiscal authority wins, and they can override the Fed.